After generating over $11 million in my 10 plus years of trading and taking one of my latest account flips from $30,000 to well over $800,000, I can tell you that fair value gaps are one of the most reliable concepts that I use daily. Yet 90% of traders don't understand them or implement them incorrectly. Whether you're hearing about fair value gaps for the first time or struggling to make them work in your trading, this video will teach you the exact framework I use to trade them profitably. I'll break down the concept in easy actionable steps that you can implement immediately. Let's talk about what is a fair value gap. Fair value gaps are a range where you might seek an entry or planned trade. It's a specific candle pattern based on concept of liquidity voids. It's gonna implement 3 candles. The gap, or what we call the gap in the fair value gap, is the empty space between candle 1 and candle 3. So as you can see from this example right here, we have 3 candles. 2 bullish, 1 bearish one. You can see with the first candle, the wick does not touch the third candle wick, right? So the space that's created in between that in candle number 2 is what we call a gap or a fair value gap. It means that the bearish orders in this case were so large that there was no bullish presence, and it created a gap that later on price might want to retarget, and we can use it for an entry, stop loss, or within our trading plan. Fair value gaps work on all time frames, and there is only 2 kinds. One is like the example I just showed you, it's a bearish fair value gap. You can see on the charts in this example, it becomes the space between this wick low and the third wick high. Now we also have bullish fair value gaps. As you can see a little bit lower here, we have a reversal, and this candle creates a bullish fair value gap. So we can see candle number 1, the space all the way up to the candle number 3 low wick. So this space right here in between becomes a bullish fair value gap. With every confluence that we have, we always have to understand the market psychology behind it. I always told all of my students that all the market simply is a representation of human emotions in the actual charts. So anytime people were fearful or greedy, we see that we oftentimes get this gap in the market. Why? Because all we have is bullish orders or bearish orders. This now creates an imbalance that an efficient market like the stock markets, the futures market, will want to target later on to rebalance and then continue the overall trend. Now fair value gaps work on all time frames. Here we have some 15-minute fair value gaps. But if we jump down to the 1 minute, we notice that we start seeing fair value gaps as well. And this is true for all time frames. But we have to understand that the larger time frames are always more important than the small time frames. So you have to keep in mind, if you're trading a bearish 1 hour fair value gap versus a 5-minute bullish fair value gap, the 1 hour should be more powerful and should be accounted more while you're in the trade for whatever the plan is that you might be taking. Now let's talk a little bit more about why I like fair value gaps a lot. And the one reason is because it stops us from chasing. Look at this example. Versus chasing the top of this candle that created a fair value gap, because you see a big green candle, you get excited, you're like, this is it, this is the trade that's gonna change my life, let me just jump in. You see price retraced into it, you could have stayed patient, wait for the halfway mark of the fair value gap to get touched, the candle to close above it, and actually have entered. And this is the best way that I like to trade fair value gaps. Wait for retracement back into it and look for an entry around the 0.5 of that gap, and wait for the candle to close above it, enter, stop loss below it, and look for whatever your targets might be. Now, what is my favorite type of entry whenever I'm using a fair value gap? I like to wait for a fair value gap that has a golden pocket attached to it. So golden pocket is my Fibonacci tool. So I'm looking for the extended move and a retracement down to that golden pocket. As you can see here, price is in a nice, strong uptrend. This is my latest leg up that created displacement, also known as a fair value gap right here. I take my rectangle tool. I see that we have a golden pocket lined up with a fair value gap right there. Wait for the candle to close. The candle closes, and then I enter a long position with a stop loss below that fair value gap. Depending on my stop loss, in this case it was 24 points, I'm comfortable with that risk, and then target a positive risk to reward. So we really like it when I have a 5-minute or above fair value gap that lines up with the golden pocket. It's one of my most favorite entries as long as it aligns with my overall larger time frame trend where I believe price should be heading towards. Now, where do I set my stop losses if I'm trading fair value gap? If I'm trading fair value gap, more often than not, I will set my stop loss with the first candle that closes out of it. So if we can see in this example, let's say you had decided to went into long there, you took this long, you set your TP, you set your stop loss would have been right on this green candle right here where price closed out of it. Now, maybe there's no other reason to take this trade, but for the purpose of the example, that's where I will set my stop losses. Now, let's go over a trade example that I took today as a short position using a fair value gap. So we can see that we're in this strong bearish trend. Now, the market opens right here at 9:30, and I'm waiting for price to give me a displacement. Right here at this 10:05 candle, I gave my first 5-minute bearish fair value gap. Now, I have two potential entries to take here. Number one is as soon as the fair value gap here gets tapped, I could have taken the short position down to a new low. But me personally, I like to wait for a better entry that also lines up with my Fibonacci tools, right? So I'm looking at the high of the pre-market, which was at 9 a.m., and the low of the market, which was that golden pocket. Now I see the golden pocket lines up as well with the fair value gap. So I'm waiting for that to get hit. So I enter right at that 0.5 that lines up with the fair value gap, set a stop loss, a closure above that fair value gap and target a new low. So as you can see, price here enters the fair value gap, kind of wicks around it for a couple candles and then sells off. So this would have been a trade I would look to get in. As you can see, pretty low risk, really high reward, and worked out perfectly. It all required for you to stay patient because as I mentioned before, those inefficiencies that were built due to the gaps in the markets will at some point come and get retested. And when they get retested, that's when you can wait for your entries. Don't FOMO down here, don't FOMO trying to chase these big candles. A good setup, a good trade will always give you multiple entries. You just have to wait for those entries, and your number one job as a trader is to stay patient and wait for your setups. Remember this, how to spot high probability fair value gaps. Always top-down analysis. If it makes sense with a higher time frame analysis, it will have a higher likelihood to actually work out. Wait for your confirmation candle to close before entering when price trades into that fair value gap. Look for the other confluences like I just showed you, golden pocket or any other confluences that you might like in your trading, like a VWAP, an EMA. It does not really matter. More confluences, more chances that trade will play out. Some mistakes that people make are they learn a new topic like a fair value gap and now they're saying that's the only thing they look for. They'll go down to the 1 minute time frame and mark 100 fair value gaps. No understanding that there is other confluences you need to look as well. Everything needs a larger time frame context to actually work. Using it in combination with your other confluences and wait for your candle closes. Now let's talk about how to trade different versions of fair value gaps. Something that I personally like to call a void. A void is whenever you have a humongous fair value gap. It tends to be due to news or some kind of event or a bunch of smaller fair value gaps stacked together. You have 5-6 candles all stacked together. Now keep in mind, those are called void. Me personally, because a fair value gap theoretically should not be a really big gap. Those are voids because it means there was a very low amount of volume, and more than likely that will be retraced much more than a fair value gap will. Whenever you're looking for those, you're gonna have to mark out 3 points. You're gonna have to mark out the top, the bottom, and the middle point of the voids. You can see here we have 2 stacked fair value gaps together. Whenever we have 2 stacked fair value gaps together, I just like to draw a larger fair value gap that covers both. Because a lot of times what you're looking at is a large time frame fair value gap or void. As you can see here, price enters it, and as soon as the first candle enters into it, you can take a long position or short position to the 0.5 of that level, of that gap, of that void. There's a high likelihood that it will actually play out. The 0.5 of that becomes your first TP, and then the full TP will become the void or the gap to get fully filled, like we see in this case. This was a 0.5 and then retraces down and then goes back up. Here are some more examples of that. We see 1, 2, 3 different fair value gaps, bearish ones stacked together. As soon as the first candle enters within that void, we see a big move right through it all the way to the top. Now we notice from this example compared to the previous one, if we go look what happens at that 0.5. Here at the 0.5, you don't get displacement through it. But on this other example, we see a big candle displacement through the 0.5, which we should expected some bearish momentum, some price to be pushed down. So that's important, understanding what are your candlesticks doing at your key levels. If you have a key level and it gets displaced like a knife through butter, more than likely the bulls are really strong through that level. You should not be looking for rejection. Understand the context or whatever you're looking at. Too many people are just wanting to a black and white answer without actually understanding what the confluences they're looking at are supposed to mean. Once you have that deeper understanding of, hey, what is this confluence actually supposed to indicate in the charts, that's when you can take your trading to the next level. That is when you can actually understand how fair value gaps work and apply them correctly into your trading. Now, another tip I like to look for is if I'm shorting, I'm only shorting above the 0.5. As we can see here, we have a bearish fair value gap right there, but a really small one, but it doesn't actually do anything. That level just gets ran through. Why? Because it's not sitting below the 0.5. Market makers are looking at price and they're looking, hey, if something is above the 0.5 retracement, it's a little too expensive, while if it's below it, it's a good deal. So if we're in a bearish trend, looking for shorts above the 0.5 all the way up to my golden pocket level, those are going to be your highest probability levels to look for short positions. So the way I would look at this, I would look at this and say, hey, anything from here to here is fair game. Like, do I have a fair value gap within that area? As you can see here, we do have a bearish fair value gap that taps into that area, so I can extend my all short range to be there. But now the opposite would be for bullish levels. Here we have a bullish example. We see that price had a really strong move to the upside. So I will draw my Fibonacci from the top all the way to the bottom, and I'm looking from any fair values that can tap into from the 0.5 all the way down to the golden pocket. So if I look at this example, I'm finding, hey, there's a fair value gap here that is below the 0.5 and right above, right into my golden pocket. So I'm looking at this whole area right here. If I want to long this trend, I need to look for a buy between this zone. So price taps, enters it, we get a candle close above it. I can take a long position anywhere near with a stop loss below the gap, targeting a new high, wherever my TP might be, and this is how I would take this trade. You need to have patience when you're looking for them. You need to look for your high probability areas, which I just showed you how to use your Fibonacci to look for those high probability areas and look for fair value gaps in those areas. We'll go mark every single 1 minute, 2 minute fair value gaps and trying to take trades off of every single one. Use the confluences, use what I teach you to only look for the high probability ones. Now you understand why fair value gaps are such a powerful tool in my trading arsenal. You're not going to master this overnight, but once it clicks, it will change everything. If you're serious about your trading, I want you to consider working with me directly. We have people like Adrian. We went from years of struggling to getting over $40,000 in recent payouts and even being the top 25 live traders at one of the biggest platforms in the world, Top Step. I actually just did a student interview with him recently on my YouTube channel if you want to go see for yourself. If you know you benefit from the added accountability and learning directly from someone who's been in the markets for over 11 years, reviewing your trades and telling you exactly what you need to work on, click the link in the description to learn more. And as always, thank you for watching.